Thank you. Good morning, and thank you for joining us for another episode of Chamber Live. I'm Karen Cross, Chief Executive Officer of the Greater Kingston Chamber of Commerce. In an ever-changing business environment, it is important for small business to understand trending tax topics and planning considerations relative to organizations. Today, we are pleased to welcome Chamber Member Michael Gaylord of KPMG to share his insights into the tax issues affecting small businesses. Today's session is being sponsored by KPMG, who's been a member of the Chamber for nearly 13 years. We're so appreciative of their continued support. Now I'll pass it over to Jessica to say a few words.
Thank you, Karen, and good morning, everyone. I'm Jessica Colvin, Manager of Business Development and Member Services at the Greater Kingston Chamber of Commerce, and I will be your moderator today. Kindly note that this session is being recorded and will be available on our Facebook page for viewing later this afternoon. Please know that we're happy to receive your questions throughout the presentation, and I would ask that you submit your questions in the chat box that you see on the side of your screen. I would also like to thank KPMG for sponsoring today's session. KPMG has been serving businesses in Kingston and Eastern Ontario for over 100 years. With over 40 professionals locally, KPMG's office in Kingston operates as one unit to bring new ideas and opportunities to clients in the private company and public sector space in audit and accounting, risk management, business advisory, and tax. KPMG is managed locally in Kingston, which allows them to make client service decisions quickly. This local strength is complemented by their ability to access KPMG professionals from across Canada and worldwide as needed. Now, I am pleased to introduce our keynote speaker. He is a tax senior manager at KPMG in Kingston and specializes in corporate, personal, and estate taxation. He works with business owners at all stages from startup, expansion, to selling or retirement. His goal is to help business owners succeed and help their family thrive. Please join me in welcoming Michael Gaylord.
Thanks, Jessica, and thanks for that warm introduction. I'm excited to be here as well with KPMG. We're excited to be here presenting this Chamber Live event, as well as sponsoring the next 5 after this one. I'm not the only speaker today. I actually have my esteemed colleague, Jake Edgar, who will be presenting with me. Throughout the presentation, we'll go back and forth. Jake, he's been my colleague, I think, for the last 7 years, also working in tax. I'll let him talk a little bit about himself later on, because I can't really do a good introduction to give it justice. So I'll let him talk about what he does. And Jessica, do we jump right in, or do I turn that back over to you?
You can start whenever you're set.
Okay, perfect. So once again, thank you for everyone for coming. Thanks, Jessica and the Chamber, for having us. We're very excited to be here. I will say this is a COVID-free presentation. There's many COVID relief programs with the government that I'm sure has been part of other presentations to the Chamber. So we're not going to get into that. If you do have questions on those relief programs, you can always feel free to reach out to us at a later time, but it is a COVID-free presentation. The purpose of this presentation is to really give a general overview of tax considerations for small businesses. And we've put together this list based on our most common interactions that we have with our clients. And we're going to provide some real life examples of what we are seeing to provide context to those situations. So get into the next slide. So here's pictures of our lovely faces for Jake and I. Jessica, you've already given the introduction to myself. I will also add that prior to KPMG, I did work for my family business in Tweed. So I grew up with the family business background. And I want to pass it over to Jake to kind of talk about himself and turn the presentation over to him.
Thanks, Mike. So that's my picture. I swear it is me. The pandemic has done a lot to my hair. So I've been with KPMG for 7 years now. I'm in my 7th year. I work primarily with private company owners and retired business owners, and I have a special interest in estate planning. Next slide. As Mike mentioned, a lot of this is going to be really general. It's really easy to get lost in the trees of the forest of tax if you start wandering around too deep in there. So this presentation is really going to be a bird's eye view of some of the key business considerations for small business owners. Next slide. So this slide may be familiar to a lot of you if you've attended other tax presentations before. It's really a staple of most tax presentations. So the concept of integration is what the Canadian tax system is built on. And what that means is really that a taxpayer should be indifferent whether they earn a dollar through a corporation or whether they earn that dollar from their business directly personally. So if a corporation earns, say, $1,000, it's going to pay this one layer of corporate income tax. And then as the corporation distributes excess earnings to shareholders, the individual shareholder will pay another layer of income tax. And those two layers combined, the goal of integration is that they add up to what that individual would have paid had they earned that business income personally. So as you can see from the table on the right here, integration functions within about a less than 1% difference of whether the business income is earned personally or whether it's earned through a corporation. So that's really the purpose of integration and an underlying fundamental point of the Canadian tax system. If I'm not saving tax by being incorporated, why incorporate at all? So the reason for that is deferral. It's tax people talk about, it's not about saving tax necessarily, it's about deferring tax. So a corporation allows a business owner to defer tax. If I think in Ontario, I'm only paying, if I have the small business rate, 12.2% tax at a corporate level. Whereas if I'm an individual earning at the maximum rate, it's 54%. So as the bottom line on this table, you can see that's about a 41% deferral rate. So if I'm earning that business income through a corporation, I have an extra 41% of cash to work with to reinvest and grow my business. That cash disappears if I take the money out right away, but it gives me the opportunity to defer tax in the corporation, reinvest in my corporation. And that's kind of what the government and finance wants, to grow the economy, to allow business owners to be able to invest in their businesses, employ more people, generate more economic growth. Next slide. Other reasons to incorporate include liability and creditor protection. So a corporation really acts as a shield to protect the shareholder and the shareholder's personal assets from exposure to liability risk for the business and creditor risk. So that's really a key legal point to incorporation. So these 3 points in the middle, they're all connected to that deferral. And a fundamental tax planning point is to use that differential between the personal corporate tax rate of 54% there and the corporate tax rate of 9 to 13% small business or 23 to 30% for corporate, to use that differential to defer tax and reinvest in my corporation. The final point I'd like to mention is the flexibility. So this is great for a retired business owner who's built wealth from their business. If that wealth is sitting in a personal investment account and earning investment income, all of that investment income is really going to fall on their personal tax return. So that could push them over thresholds where the retired business owner may not be getting old age security anymore, or may be pushed right up to this 54% tax bracket, depending on the level of their investment income. So investment holding corporation for a retired business owner really allows the flexibility to control how much income from those investments are on my personal tax return. So that money is invested in the corporation. The corporation's paying tax on it. I can choose to take a dividend to pay tax personally, or I can choose not to, and I can ensure that I gain access to the old age security payments that I should be entitled to, or control what tax bracket I'm in. On this slide, I'd quickly like to mention why not to incorporate. So a key reason is that any business losses earned in a corporation are trapped within that corporation. So they can only be used against other income within that corporation. Whereas if I have business losses on a personal tax return from a sole proprietorship, I can utilize those losses against other types of income that I'm earning personally. So it really, as a new business owner, it doesn't necessarily make sense to start with incorporation because I may generate losses in those first few years, and those losses can be used to offset other forms of income I may have. So just to keep that in mind, there may be a legal liability protection reason to still incorporate, but just to keep that in the back of your head, as well as coming back to the tax deferral. If I take every dollar out of the corporation every year, I'm not in any better position than I would have been if I had just earned that personally. In fact, I'm probably in a worse position because I've paid legal and accounting and tax fees, professional fees to operate that corporation. Next slide. Now that I have a corporation and I've decided on earning income through the corporation, compensation planning is really a key point. So consider your personal spending habits and the after-tax funds you require in that compensation planning, always keeping the deferral in the back of your head that if I'm just spending all the money personally anyway, maybe the incorporation didn't make sense. So then it becomes salary or dividends. What do I want to do? A salary, if I pay a salary to myself, that's deductible within the corporation, whereas dividends are not deductible within the corporation. So a salary is going to reduce corporate tax in the corporation, but a dividend won't. And then a salary is subject on a personal tax return to the highest rate of 54% in Ontario, whereas a non-eligible dividend would be only 48% maximum in Ontario. So and if you think why that is, it's because I've already paid a layer of corporate income tax. So the dividend should be cheaper, really, because it's paid with after-tax profits. In determining whether to pay salary or dividends, I have kind of a rule of thumb of thinking CPP or RSP, and the CPP being that if I have pensionable earnings up to the maximum amount where I'm paying into CPP, so that maximum amount is about $61,500 currently, and it grows kind of with inflation every year. But if I pay into CPP, that means I'm entitled to take CPP later in my retirement. If I haven't paid into CPP, I'm not entitled to it. So for remuneration, my personal starting point with advice is to start with maximizing that CPP entitlement, just so in retirement I have that government pool of money that I'm entitled to. And a client story related to that, we had a client that came to us from a different account for many years, and he had always received his remuneration by dividend because it was cheaper tax-wise for him to do that personally. But in retirement, he wanted to get CPP. He had never paid into CPP, so he wasn't entitled to CPP. And that kind of was decades of not necessarily poor planning, but he wasn't entitled to CPP. And I always think it's best to get that pool paid into first. If the company has excess funds to pay out, then my next rule of thumb is to maximize RSP contribution room. And currently that's results from a salary of about $155,000. That's also pegged to inflation, so rises a little bit every year. But the reason I would say that is that ensures there's retirement planning available for the future. Like it gives this pool that the business owner doesn't necessarily have to pay in the funds to the RSP every year, but it still gives that option that in some future year, there may be a big income inclusion, say the business is sold or a large investment was sold or a rental property was sold. It gives that opportunity to be able to make a large RSP contribution and kind of opens the door for that retirement planning, even if it's not necessarily used. Over and above that $155,000 mark, my starting point is always dividends to start utilizing the benefit of the lower tax rate of the dividends. And that's not really a rule. It's just a starting point. There'd be lots of exceptions where maybe the business wants to keep paying a salary above that $155,000 threshold to get more deductions within the corporation. So on to shareholder loans. One interesting point I'd like to make about shareholder loans and paying a dividend. If I declare a dividend payable, I don't necessarily have to pay it to myself. So there could be cases where a business wants to declare a dividend, say $50,000, but doesn't want to take those funds out of the company. And that would impact the shareholder loan account such that the company would owe me as the shareholder $50,000 that could be extracted at any time in the future tax-free, because I've really already paid the tax on it. And reasons to do that would be to utilize some of the lower tax brackets and just to build that pool of tax-free money I can extract at a later date. The shareholder loan can also work in the other direction. So if I take out more money from the company that has been declared as dividends or salaries, then really I'm borrowing from the company. And that creates a tax issue in the sense that if I don't repay that back to the company within a year, it's actually by the end of the following fiscal year, but within a year, that income or that loan that I've taken from the company is actually an income inclusion on my personal tax return. So be really cognizant of taking loans out of the company. There's ways to manage it, but the rule of thumb is within a year, it should always be either repaid or cleared out by declaring a dividend or salary bonus to kind of eliminate that shareholder loan. Finally, what about paying family members? What about splitting income with lower income family members? So finance, I think 3 or 4 years ago, introduced the tax on split income, which really made it punitive for taxpayers to kind of play games with income splitting in the family. It's a really complex topic. I'm not going to get into the weeds of it at all, but generally the rule of thumb that I would say to use is, would I pay a stranger the same amount to perform this same role that my family members performing? So if I pay my adult child $50,000 to do kind of occasional record keeping or odd jobs, but I would only have paid $5,000 to a stranger to do that same role, that's gonna, like CRA is gonna have a problem with that, and it's gonna generate that tax on split income, and which is quite punitive. Next slide. Really briefly, I wanted to touch on a couple of different types of taxes to consider within a business structure. So there's the personal tax, obviously, that we all know. For corporate taxes, there's a number of different tax rates. In Ontario currently, the starting point for active business income is 26.5%. And that corporate rate can be further reduced to 12.2% in Ontario if the corporation meets the conditions of the small business deduction. And so if those conditions are met, which it would be for most of you, it's not hard to, but you still have to do the analysis of whether it is met. If those conditions are met, the first $500,000 of income can benefit from that 12.2% tax rate. And anything above that amount would be the 26.5% rate. So it's not like you go over that line and suddenly everything's in the 26.5%. It's always the first 500,000. And that 500,000 is analyzed based on an associated group. So it's not necessarily one company. And association and tax is also complex, but in simplest terms, if I have controlling ownership of 2 or more companies, those companies are associated and are required to share that one $500,000 limit. Really quickly on passive income. So passive investment income generated within a corporation is subject to the refundable tax regime. This regime is extremely convoluted and kind of gets more complicated every year. I'm not going to get into the weeds of it, but in short, if I have a corporation that earns investment income, I have to pay 50% tax on that investment income in the corporation. But then when I pay a dividend to the shareholder, the corporation recovers a large portion of that refundable tax. Different types of payroll withholdings. So if I'm doing salary, I have to remit federal tax, CPP, EI as applicable to the CRA. So we've discussed CPP. It's an extra cost to the employee. It's an extra cost to the employer, but it is beneficial because it gets you in that CPP pool for retirement, and any CPP payments by the employer are tax deductible fully. Mike will talk about EI in a few moments. He has a pretty good personal story about it. Another kind of obscure tax that people don't really think about is the employer health tax, so EHT. And so that's a special tax in Ontario. Each province may have their own payroll health tax, but Ontario's it's based on the size of the payroll and can be up to 1.95% of the payroll. There is an exemption of 1.2 million currently, so it doesn't apply to your payroll unless it's over 1.2 million. So a lot of smaller businesses are exempt from it because they meet that exception. It's just really critical to note that the EHT is also similar to that $500,000 threshold. It's subject to the association rules. So we had a client that clearly was below the threshold, but he and his brother owned a second corporation together. And that caused the two brothers, all of the corporations they each owned were now associated. So we had to look at this EHT exemption based on the entire group, and it resulted in the EHT being applicable for kind of any payroll within that group. So really if there's multiple corporations and shareholders in the group, really be cognizant of any unintended consequences because it can get a bit messy. Very, very quickly on HST. So small suppliers don't have to be registered or remit HST, but as soon as you have sales of greater than $30,000, then you're no longer a small supplier and you have to register and start collecting HST. Important to note is that 30,000 threshold, it's not necessarily based on the calendar fiscal year. It's a 4-quarter sliding scale that maybe I pass in Q2 of year 2 because of Q3, Q4 of year 1, plus Q1 and Q4 of year 2. So just keep in mind that it's based on a quarterly scale that's always sliding. It's not based on the calendar or fiscal year. And there could be a benefit too of registering early. So if I'm a registrant of HST, I'm entitled to claim any HST I paid to earn income as an input tax credit. So say I started up a business, I have a lot of expenses in the first couple of years. In the first year, I've paid 5,000 of HST, but I've only made sales that would require me to charge 1,000 of HST. So I could, if I'm a registrant, I can file my return and get a refund of that $4,000 net difference. So it really, there's benefits to registering early if you are in a refund position for sure. I'll pass it to Mike now for his EI story and to continue.
All right, thanks, Jake. So with EI as a business owner, you may put yourself on payroll with your other employees, and the default is, EI just applies because that's what you've always been used to. You've had other jobs, but as a business owner and with your family members, you need to stop and ask yourself, does EI actually apply? Do I need to pay these premiums? Because what happened in my situation, working for my family business when I was younger, my father, my brother, and myself, we were all on payroll while we worked, and we were having EI premiums getting taken out on our pay, and it would all obviously be on our T4 slips. And then someone mentioned to my father, you know, you probably wouldn't get EI if, you know, the business ceased to operate. You wouldn't qualify for EI. So why are you paying EI premiums for something that you're probably not going to get? We ended up putting in a EI ruling request, which came back to say, yep, EI doesn't apply. And we were able to recover 3 years worth of EI premiums that we had paid. So it's just, you know, it's cash flow that's going out. You want to make sure that if you're paying into EI, that you're actually eligible to receive it in the event that you need it. Because otherwise, you know, it's money going out of the company that doesn't need to go out. So I would recommend getting an EI ruling if you're unsure of your current situation. So I'm going to go over now just some other deductions that you would get for your business income. And generally, whether you're a self-employed proprietorship, so you report your business income on your personal return, or it's in a corporation, the same principles apply. So most expenses are deductible if they meet all three of the following criteria. So incurred to earn business income. So you want to make sure that whatever expense you have or whatever you've done, there's a reason you've done it in order to earn business income. Lots of times we'll see in a corporation, you may loan funds to maybe a family member or a friend to their corporation or to them personally with zero terms attached. So maybe you loan another corporation $10,000. There's no interest attached to it at all. If that business, say, goes bankrupt or the loan goes bad, you probably won't be able to get a deduction for that bad debt of the $10,000 because the CRA could come in and say, well, what was the purpose of earning business income? You loaned funds with no interest attached to it, so there was really no way to earn any income off of that. So generally, we will say if you're going to loan funds to another corporation or someone, you should charge some type of interest rate just to have that, you know, business income purpose. The other point are reasonable in the circumstances. So you want to make sure the expenses that are going through your corporation, they're reasonable given what you're doing. Lots of times this is an issue when it comes to non-arm's length transactions. So say you have other corporations or there may be family corporations where there's rent charged. You want to make sure there's fair market value rent being charged. Otherwise that could get adjusted. And another big one we see is management fees. So if you're charging management fees to another corporation that you're related to, you want to ensure that there's a reason behind how you've come up with that amount for management fees. The CRA doesn't like to see, you know, you pick a management fee at the end of the year to basically move profits from one corporation to another corporation in order to use up losses. They can deny that. So it's always just make sure it's reasonable based on what's going on. And then the final point are allowed by the Income Tax Act. I don't know if everyone's seen the Income Tax Act in person, but it is a beast and it's very complicated. But generally, all expenses can be covered at some point in the Income Tax Act. For unusual circumstances, lots of times it requires additional research into the Income Tax Act just to see if it applies. So just those are kind of the three criteria that you need to meet. And some items that go through the business that aren't deductible. So lots of times personal expenses, they wouldn't meet this criteria of, you know, incurred to earn business income. So generally it'd be a non-deductible expense. And then you could get into the issue of, you know, there's personal expenses being paid by the corporation, which is non-deductible to the corporation. And then you could have a taxable benefit applied to you so that you're paying personal tax on an expense where the corporation didn't get the benefit of that expense. So generally what we would do is any personal expenses that are non-deductible, you would have that included in the shareholder loan account that Jake mentioned earlier. And then you would get that cleaned up by either paying it back or perhaps you do a dividend to avoid it coming into your personal income at the employment income rate, so at the 54% at the high level. One of the big parts of running your business are your capital assets. So, you know, the most common is you have a building, maybe you have vehicles, you have equipment. And there's a difference between how they're treated for accounting purposes and how they're treated for tax purposes. I'm not going to get into the details of whether something is a capital expense or whether it should just be a repairs and maintenance expense. That's a kind of a different conversation. I want to just get into the timing difference between accounting and tax. So for accounting, generally you may pick the useful life of an asset. So you say you have a piece of equipment and you say it's 5 years is the useful life. You would depreciate that equipment over 5 years for accounting purposes. Generally, there's a half-year rule. So in the first year you purchase an asset, you only take half of your normal depreciation. But then going forward, each year you would have the same accounting expense. But for tax purposes, the depreciation is actually based on a declining balance method for most classes for tax purposes. So you may have a class that's 20%, where each year the remaining balance is going to be depreciated for that 20%. So the amount deducted is lower every year, and it continues until really that asset is disposed of. With the current environment and making sure to remain competitive with the US and encourage business investment, the government has announced some tax changes for capital assets purchased after April 19th of this year, which allows for 100% write-off of those expenses that meet the criteria. So in these circumstances, you're going to have a difference between what your accounting numbers say and what your tax numbers say. So if you had a $10,000 piece of equipment that was purchased, for accounting, you're maybe going to depreciate $1,000 in this first year. You're doing it over 5 years because of the half-year rule. But for tax purposes in this first year, you're going to get a deduction for $10,000. So you get that benefit right up front for tax purposes. But then in year 2, for accounting, you're going to have a depreciation expense of $2,000, but you're not going to have a tax expense related to that asset because you've already realized it in the year before. So there could be circumstances where you have accounting income of $0, so you may not be expecting to pay any tax, but your actual taxable income is $2,000 because that accounting depreciation gets added back and there's no tax depreciation. So then you will have a tax bill. So there's no changes in the amount you can actually expense between accounting and tax. It's just the timing difference that comes into play. And on the slide, just to note, for some vehicles, mostly say personal vehicles, there is a limit as to how much you can expense, which is $30,000 for tax purposes. So effectively, you could have a personal vehicle that was $45,000 for accounting, but for tax, it's only $30,000. So there's a bit of a difference when it comes to timing and what you're depreciating. That's not for all vehicles. There are other vehicles that don't have the limit of 30,000, but that's the most common that's there. And the other note on your capital assets that you're purchasing, you want to be forward thinking as to when you're making these purchases, because you can sometimes recognize the expense earlier than maybe what you originally intended. So if you have a December 31st year end and you're planning on buying vehicles, in January, you may want to consider making those purchases in December because you'll be able to expense those purchases from tax purposes in December of that year, as long as they're available for use, as opposed to making the purchase in January. So you have the cash going out and then you're waiting that full year before you can get the benefit of the tax expense related to those purchases. So it's always nice to, talk to your accountant. If you are making some big purchases, especially early in a year, you could get a benefit of doing them, a little bit earlier. Speaking of, vehicle expenses, so in automobile expenses, generally you'll have your fuel, maintenance, insurance, license fees, you'll have some of the depreciation, and it's normally the business portion of these expenses that are deductible. And it's very important with, CRA that you're really being organized and keeping track of the mileage that you've used for business purposes. Generally, you keep a travel log that will, calculate your business mileage over your total mileage. And the CRA has noted travel to and from work is not business travel. That's personal travel, just going to your regular work. With the corporation, there's, you can have personal vehicles that are owned by the corporation that you have access to as the individual. In those circumstances where the corporation owns the vehicles, you as the individual could have a taxable benefit that applies relating to what they call a standby charge or an operating cost benefit, which is effectively, you have the ability to use these vehicles. So you're going to get charged with a taxable benefit that would show up on your T4. And for this standby charge, it's calculated based on the fair market value when the vehicle was originally purchased. We had a client situation, it was a new client, and we found out that they had a $75,000 car that was purchased in the corporation. It was basically their personal vehicle. So they were having a standby charge that was calculated on that original cost of $75,000. So it got to the point where each year the vehicle is worth less and less, but they're still getting a taxable benefit based on that $75,000 value, where it eventually got to the point the standby charge was more than the actual value of the vehicle. So it's not a tax efficient structure whatsoever. So going forward, we had the person purchase the vehicle for the fair market value to get it out of the corporation and remove that standby charge. You can have personal vehicles that you own and charge the company for your mileage. So similar to, you're an employee, you have an expense report for all your mileage related to work. You submit that expense report, the corporation pays you back, there's no taxable benefit, and the corporation has a business expense for that travel. So in that, you still want to make sure you keep a personal log to show what your business expenses are. And the CRA generally has 59 cents per kilometer for the first 5,000 kilometers, and then 53 cents per kilometer after that. So there's options as far as what you do with vehicles. Do you own them in the corporation? Do you own them personally? Do you purchase them or do you lease them? There's a lot of different variables that come into play. So you should talk to your accountant or your advisor to really figure out what is the best situation for you, because everyone's circumstances are going to be different. Another kind of big area of, say, CRA focus, and what we'll see with a lot of our clients is entertainment expenses. So generally, meals and entertainment are 50% deductible. There are some exceptions to that 50% rule. Corporations, if you have a company-wide events, you're allowed up to 6 per year where you can fully deduct the meals and entertainment. So if you want to have a company-wide barbecue where everyone's invited, those expenses would be fully deductible and not be subject to this 50% limitation. Similarly, there are kind of convention shows the company could go to 2 a year that are fully deductible and not subject to the 50% rule. So just the one thing to note with these expenses, you still want to make sure there's a business purpose attached to them. So having good record keeping, recording client names, the purpose on receipts is very prudent. You should do that. You want to make sure that you're reasonable, because as we mentioned on the slide, avoid being red flagged by CRA. And the big part we talked about earlier, you don't want to be taking your family to dinner and having all those expenses go through the corporation, because that's not reasonable, and you could get into the place where it's 100% not deductible, and then you have a shareholder benefit that you pay tax on. Some common non-deductible expenses, so golf memberships, gym memberships, those generally they're not deductible, so they're not an expense to the corporation. However, if there are, say, food and beverage purchased at a golf course that is business related, it will be subject to the 50% rule, where previously, quite a while ago, any expenses at a golf course were non-deductible. So if you do have food and beverage at a golf course that's business purpose, it is subject to the 50% rule. So kind of mentioned it on earlier, but it's very important to keep your books and records in order, have support for all your receipts. Being organized especially can help with your professional fees. So if you are organized when you're submitting your information to your accountant, maybe it's once a year to do your financial statements and tax returns, it can save on fees if everything is organized and the accountant is not digging through all the information, trying to understand what this expense is, where does it go, how is it recorded properly. So one way to do this is to really keep your corporation clean. So separate out your personal expenses from your business expenses. So having separate bank accounts and credit cards is very key. The onus is on the taxpayer when it comes to a CRA audit. So keeping all your receipts, mileage logs is very important, because if the CRA does come in and you can't prove an expense or a business purpose, they can deny that, so you don't get that deduction. And also, if you have mixed in personal and business and there are deposits into the account, we've seen it in the past where you can't explain what a deposit is. It could have been just you putting money into the account, taking it out a couple different times. But if there's no real trail, the CRA could potentially just add that as income, even though it's really not. But because you don't have the proper records, the CRA is just going to add that into your income. So I'm going to pass it back over to Jake, who actually has some kind of stories of what he's been seeing recently with our clients and the CRA.
Thanks, Mike. So I've seen a couple particularly nasty audits in the last 2 years that relate to sort of what you've been talking about. The first is with corporately owned vehicles. So a corporation owned multiple vehicles that their employees used for business purposes, but they also could take them home every night and use for personal purposes. And there was no real record keeping done by either the employees or the employer to differentiate mileage as personal or business. So when the CRA auditor came in, they really didn't have any way to figure out how much is personal use on these vehicles. So what they ended up doing was using Google Maps to measure the distance between employee's house and the office, figure out, oh, they probably worked 250 days in the year, factoring in their vacation and stat days. So that mileage based on that arbitrary number of days is how much was kind of considered a taxable benefit. And there was no way for the client to argue, oh no, I drove straight from my home to a client site this day, or I didn't come into the office this day. There was no record keeping to support any other position. And it kind of, the auditor, they couldn't do much more than that. And then if the taxpayer argues, the onus is on the taxpayer to provide proof. And if they can't provide proof, then it's not going to change really. So that was one that really added like thousands of dollars of extra employment income onto multiple employees' T4 slips across multiple years, and really was like a bad scene for the employees and the employer as well, because some of the charges were subject to HST. So that really could have been avoided by, or not avoided, but mitigated by better record keeping, mileage logs, and even a better understanding of the rules. So the second one relates to meals and entertainment. And an owner would have regular meetings with clients, lunch, dinner meetings. They didn't really keep any records of what the business purpose of the meeting was, who was at the meeting. So when the CRA came to audit, they're put in a position that, oh, we see X amount spent on meals and entertainment. Like, who were you eating with? Why were you, like, what was the business purpose of this? And there was no kind of supportable position to really any of the meals. So it ended up that the CRA denied all of the meal expenses in the company. And then if they weren't business expenses, they were personal expenses. So they applied all the value of all the meals as a taxable benefit to the shareholder owner. So it ended up that really it was subject to double tax. There was no benefit of a deduction in the corporation, and the shareholder paid tax on this amount. So the CRA doesn't want to get to a double tax position. Nobody does. But if there's no records to support, then it puts it in a spot where double tax could apply, unfortunately. And that could have been mitigated by keeping a journal that included what the business purpose was, who I ate with, blah, blah, blah. So really the proper record keeping, it doesn't seem like much to do while you're doing it, but in the event of an audit, it is really critically important. Next slide. So this is another consideration that it's really hard to do quickly, but estate planning is really important. Like this should be its own full presentation. So I just wanted to really talk about this for 2 minutes. As a business owner, you should really always have a will, no matter your age, your health. Just always have a will, just to make sure your wishes for your business and your assets kind of pan out like you want them to. I've seen a couple pretty nasty situations where there weren't wills, and I know the deceased business owner, they had wishes which weren't being followed because there was no will to make somebody follow them, essentially. So estates in Ontario are subject to probate, most of the assets within, and probate includes a estate administration tax. The first $50,000 of an estate are exempt from this tax, but any value above that is subject to a 1.5% probate tax. And that doesn't seem like much, but for a wealthy estate, that can really add up. Like a $10 million estate, that's $150,000 that really you can start to plan to address. So with high wealth estates, you should be doing probate planning to kind of mitigate that, the 1.5% probate tax. And that can be done with having a secondary will to kind of govern what happens with private company shares and take it out of the probate realm. Or there's further planning that can be done with trusts to kind of address that probate planning. So I'll pass it back to Mike to finish off, but thanks everyone for the opportunity today.
Thanks, Jake. And kind of just adding on to, will and estate planning. As a business owner, there's many different circumstances that could come up that you don't really want to think about. But, if you were to pass away, become disabled, become critically ill, there's different issues with your employees. What would happen in those circumstances? So on the slide, we mentioned life insurance, disability insurance, critical illness. Sometimes you can have corporately owned life insurance policies to give you different flexibilities as far as what you're doing. But generally where we would see some of these decisions made, especially if there's more than one owner to a business, is having a shareholders agreement. It's very important to help with what happens if someone does pass away. How do you work with the, say, surviving spouse of your co-owner? How do they get bought out? It's very important because we've seen that in the past where there's two owners, one of them passed away, and the business suffered because the one owner that was actively involved was dealing with the estate of the surviving and the surviving spouse, and they had disagreements as far as how the business should be run or how they should get paid out, and it resulted in the business suffering because the focus got taken away. So a shareholders agreement's not only just for catastrophic occurrences, but it's also to have set up as plans for, if there are disagreements between co-owners, what happens if someone wants to get bought out? How do you, get that to be fair for everyone involved? So lots of times you may start a business, two friends start a business, everything is fine, but then something does happen or you have a disagreement, you get to a standstill. How do you correct those? So planning, being proactive with a shareholders agreement can help avoid some of those situations. So very important. And just with insurance in general, it's always best, to have insurance when you don't need it. You don't ever want to have to rely on it. But if you are going to, go with insurance policies, talk to your advisor to determine the best spot as to where you should be holding it. So, your operating company, your holding company, or should you be holding it personally? So final thoughts. As a small business owner, there's a lot of tax considerations and business considerations that you're aware of when you're, growing your business, running your business, and you're super busy as a business owner. The last thing you want to have is a surprising tax bill at the end of the year. So I always like to say, be proactive with your accountant, your tax advisor. If you are considering, making a large purchase or you have a transaction that you're working on, reach out to your accountant to see, what is the potential impact? How is this going to be treated? What's a tax efficient way that we can structure this transaction? Because you want to avoid those surprises. And I always like to say, hopefully you're meeting with your accountant more than once a year, and that you actually, have a trusted advisor relationship with your accountant so that they can help you with your personal needs and your business needs and really get you to where you want to be and have you focus on your business as opposed to, the complicated tax world. So thank you everyone for your time today. And we look forward to the future presentations that we're going to be sponsoring with the Chamber Live events. So is there any questions I think we have at the end?
Yes, that's correct. So we do have some time for questions. I will monitor the chat, but also feel free to unmute yourselves and just ask either of our speakers if you would like. Now is your chance. And I just also want to thank both Mike and Jake. That was a fantastic presentation and very informative.
Yeah. And we will say, if you don't have any questions like right now, you can always feel free to reach out to us at another time. We're always happy to have conversations or meetings with people.
Wonderful. And just a note from Matt that said, great presentation and thank you.
Thank
I
you.
want to say too, it was a great opportunity to reinforce the fact about good books and records. Keeping things neat and clean and tidy saves time and money for everybody.
All right. Well, it doesn't look like we have any questions at the moment, but again, if you do have some later, please feel free to pass them along to us and we would be happy to share with both Mike and Jake. So I guess that's all the time we have then for today. Thanks everyone so much for joining us, and we hope to see you again for our next Chamber Live on Tuesday, October 4th, titled People and Change, Managing a Hybrid Workplace and Legal Considerations. Over to you, Karen.
Thank you, Jessica. And I'd just like to say one more final thank you to Michael and Jake and the team at KPMG, not only for the presentation this morning, but for sponsoring today's session and the next few sessions we have coming up. So we appreciate your continued support. And thank you everyone for joining us, and enjoy the rest of your day.
Thank you.